I'm Jeff Huzek, and this is the May 2021 Market Update webinar. So let's get started. First slide, obviously, always the disclosure slide here. So this presentation is for educational purposes only, not to be viewed as investment advice or investment guidance of any kind. Investing involves risk, including the potential loss of principal. We've got the states that we're registered to do business in as of right now. Leave this up for a few seconds, kind of allow everybody to read through that a little bit. My contact information there on the bottom, email address, phone number, address. Quick bio page for me. About 16 years in the securities industry, worked as a consultant for a fund company in Chicago, covered New York City. I have 2 professional designations, the Chartered Market Technician and a CPFA, which is Certified Plan Fiduciary Advisor. In addition to a handful of security licenses. We manage money for individuals, families, as well as small business and corporate retirement plans. Topics to be discussed. As always, I usually start with a bullish versus bearish argument, kind of top 5 reasons to be bullish and top 5 reasons to be bearish. I want to go over kind of capital gains tax in relation to market returns. That's been in the news a lot lately. Kind of the all asset momentum breakdown chart. I introduced that to you guys last month. And then kind of talk about just, market health, market breadth. Advanced decline line is showing some weakness, especially in regards to the NASDAQ. Which sectors are performing well, which sectors are kind of, stocks are making new highs. And then, we're a little bit past a little over 12 months from the bottom from the crash of March of 2020, which bottomed out on March 23rd of 2020. And so, how does the S&P, how do the markets do in year 2 after those major crashes? So kind of look at that and, maybe some things, kind of a glimpse into the future of what we can expect over the next, few months here. So reasons to be bullish versus reasons to be bearish, in my opinion here, bullish arguments are fundamentals are still really strong. Things look good. Earnings that have come out have been really solid. So I think that's always a good thing. Global asset shortage. I've touched upon that in the past a bit. If people want to, talk a little bit or have me talk a little bit about more of that in the future, I can certainly do that. Just let me know. Low interest rates. They have risen a little bit over the past, 6 months or so, but, still low from a historical context. Credit markets are not really signaling any issues. So I don't think there's any major issues, on the surface just yet. And then momentum is still strong. It's weakening, and specifically in certain areas of the market, but it hasn't completely, crumbled by any stretch. I mean, momentum in general still is pretty solid. There's some issues going on, and we'll walk through that. Bearish arguments. U.S. equity markets are a bit stretched. As I mentioned, we're a little bit over a year past, the bottom in March of 2020. Markets had quite a run over those 12 months, kind of historic run. So they are maybe a little bit stretched, need a little bit of consolidation here. Definitely some inflationary concerns from people. I think those are a little bit overdone in my opinion, but it's still out there. Signs of reckless investing, especially, some things going on in the crypto world and other just random securities that have gotten driven up on price or in price based on really nothing. So just some signs of reckless investing going on, and that's never something you want to see. You're not typically going to see that in the beginning of a bull market. That usually happens, maybe towards the end. So seasonality coming into the summer months here. Old Wall Street adage, kind of sell in May and go away, just, talks about the fact that the summer months are typically more volatile. That's not something you don't want to base an entire investment theme around that. But in general, that's just something that, it can play a part. The summer months can be a little bit more challenging. And I think that coupled with the whole coming into year 2 of recovery, I think those things may line up this time around. And then momentum weakening a little bit. So we'll walk through that. First chart here, capital gains tax, right? So different time periods where capital gains tax were risen. You can see, 68, 69, 70, 71, 72, and so forth. And then what the market did during that time period. So I think, again, this is not a political rant or anything like that. I don't take politics into the equation when it comes to investing. I think that stuff is more noise than anything else. I think you have to go off of the data. Again, I'm not saying that this is leaning one way or the other. I just, historically speaking, capital gain taxes, when they've gotten, risen, they haven't had this, oh, the market's going to crash because of that. That's just going off the data again. So I think that stuff is more noise in the background when it comes to investing. Unless you're ultra wealthy, it probably won't affect you. And again, I wanted to throw this up there. I think if the market does have a pullback over the next 3 to 4 months, that will probably be one of the things that, people are talking about in the news and saying, oh, it's because they're talking about raising capital gains tax. I just don't think that will be the reason why. I think the market will have a pullback because the market probably should have a pullback. It won't be because of that. So I think that's just going to be more noise in the background. So just something that I want to throw up there for people that think, oh my gosh, the market's going to crash because of it. I don't see that happening. And, history would definitely side with me in that case. This is the kind of that all asset momentum chart I showed you guys. I think the first time I brought this into the webinar was last month, and essentially you'll notice it just takes a bunch of different areas in the market: bonds, inflation, interest rates, volatility, cap weighted ETFs, and then a bunch of different sectors, equity sectors, some energy, alternative energy. And it's really just a chart showing, it's something that I calculate, showing where momentum is in the market currently. It's the data for obviously those bottom months there. So going into March of last year, obviously bonds and, volatility were showing a lot of momentum, which that makes sense. Obviously the market completely imploded, but those were showing going into that whole time period that, hey, there's some issues, especially from a volatility aspect. In the summer months of last year, you wouldn't want to really be in bonds much at all. Definitely want to be more equity. That's where you're seeing more momentum. And as we get here, bonds have certainly, it seems like bonds have bottomed a little bit from a short-term perspective. What areas of the market you're seeing more defensive areas are starting to show more momentum. And that's been the case for a few months now. In large cap, you're seeing value looking better than growth. Mid cap, value looking better than growth. Small cap, same thing, value looking better than growth. Look at the equity sectors, which ones are showing momentum, right? Utilities, consumer staples, financials, real estate, the ones that when the market's going crazy and is going through a great time period, the sectors that you usually see doing really well, technology, consumer discretionary, have not been showing much momentum the past few months. And I've talked about that for a few months in a row, that technology is not the place you want to be right now. And I'm going to go through that a little bit today as well. So again, I think we're starting to see a shift into more defensive areas of the market. Now, that doesn't necessarily mean that, hey, the market's going to have a major crash or anything like that. It just means that maybe the easy money for the short, the short time period here, maybe some of the easy money has been made, might be a little bit more challenging of an environment. That doesn't necessarily mean we're going to have a major drawdown or anything like that, but could we see a few 10% corrections over the next 6 months? Yeah, I think so. And I think that's probably in the cards. I definitely don't think the market's going to go straight up for the next 4 months. That's just based off of the data. Again, that's how we make our decisions. That's kind of where everything's, leaning. So I talked about kind of where we are. We're in year 2 now from the recovery from the major crash last year, right? And so I want to compare that to basically the dot-com bubble and the financial crisis, and look at them from what year two was like versus the first year after. So here we've got the bottom from the dot-com bubble. This right here is October 2002, right? Was the bottom in October 2002. Now obviously it had a major, drawdown here again in 2003, but this was essentially the bottom for the S&P. And this is the first year. So this is October 2002 right here, right? And this is exactly 12 months later. So this is, mid-ish October of 2003. Obviously, a huge run here, right? In that first 12 months from the bottom there. Here's year 2. So this is, October of 2003 to October of 2004. Obviously still had a nice run up, but then things got really choppy, right? Things are a lot more difficult in the second year recovery. And it kind of makes sense because when prices get depressed, so much, right? They certainly kind of springboard off that bottom, right? Everything looks attractive. Everything gets, oversold. Everything looks like, oh, wow, what a great value. You can buy, this stock at this. Wow. So everyone jumps in, prices get risen up a significant amount. And at some point they typically get overvalued, right? Or overbought. And when that happens, then things get a little bit more difficult to navigate. That's exactly what happened after the dot-com bubble, right? You had that really good first year and a half or so, and then all of a sudden it's like, okay, well, it's a lot more difficult. Things consolidate, choppy market, and that's kind of what happened there. And if you look at the time period too, right? Like talking about seasonality, I don't think seasonality always matters, but in certain time periods it does. I think this is clearly one of those time periods where it did, right? Summer months, right? And I talked about that earlier. The summer months kind of sell in May and go away. This was one of those time periods where it was a lot more difficult during the summer. So this is, again, right after the dot-com bubble, year one on the left, year two of the recovery on the right. Year two, a lot more choppy, right? Same thing here in the financial crisis, coming off the bottom March 9th of 2009 here. Here's the first year. So this period on the left, March 9th, 2009, March 9th, 2010. Okay. And then the end here would be March 9th, 2011. So this is year one of the recovery, right? Huge run up here. Makes sense. Again, prices were really depressed. Everything looking attractive, everything oversold. Everybody buys in, money pours in, the market drives the market up significantly. Probably to, a little bit too much at, certain time periods. And here's year two, right? Again, a little bit more difficult. Now, still had a really good year here. Still ended up really well, but this time period right here, again, difficult, right? A lot of people remember this time period and people freaking out. Oh my gosh, the market's going to drop all the way down again. Obviously that didn't happen. It really wasn't expected. That was, I think people freaking out that the real estate thing hadn't bottomed out already. But again, year two here, choppy market. And again, look at what time period it is here. May, through September, those summer months, again, seasonality kind of came into play there. And I think we're in the same situation here where here's the bottom from the crash of 2020, March 23rd, 2020 to March 23rd of 2021. This is where we're at as of a few days ago. We've had a huge run, historic run coming off those lows from last year. Again, expected. The market fell like 38% in 28 trading days. It was, the fastest drawdown of that magnitude in the history of, the US stock market. So expected that things got really, really, really oversold. Everything looked attractive. Money pours in, shoots prices way up. We're still going up. We're still in a good spot here, but we're just getting into the, those summer months, and we just had that huge historic run. It would be, I think it would make sense to have things consolidate for a while. I think, and that would be okay to make sure things don't get too overvalued, right? And so when, again, talking about seasonality, I don't always think it matters. I think sometimes you're better off just going off of, what's going on from a valuation aspect and things of that nature. But for now, I do think seasonality will matter a little bit more, I think, based off of the run that we've had, in addition to what's going on internally in the market. So I think we're probably headed for a little bit of a choppy market over the next few months. Who knows? Again, we go off of data, so we're not going to, downshift just because that's what we think will happen. We're going to go off of what's actually happening in the market. So this is a chart. So one of the things that we look at is, to kind of measure market breadth is, the top line is the S&P 500. So the green is the S&P 500. The black line is the NYSE AD line, right? AD is advanced decline line. So, and essentially what that is, it's a technical indicator. It plots a difference between the number of advancing and declining issues on a daily basis. And it's a cumulative number. So if it's positive, it adds it to the previous value. If it's down, it subtracts it from the previous value. And so essentially what you want is, if the market's going up, then you want, a large number of stocks participating in that uptrend, right? Remember that indexes are not equally weighted. So just because the index is up for a day does not mean the majority of stocks were up for a day. And vice versa. Just because the index is down for a day doesn't mean the majority of stocks are down for a day. There's a lot of other variables that come into place. How much weighting does a stock have on a particular, index really plays a part. But you do want to see it in a strong uptrend. You really want to see a large number of the stocks participating in that uptrend. If you see the market rising over a fairly long period of time, meaning weeks to, a month or two, from that aspect, and you see less stocks participating in that uptrend, well, that's really telling you like all the companies aren't really participating in that uptrend, right? That's not what you want to see. And that's, you can kind of see that by these red lines here. The S&P, made new highs, right? Not as many stocks participated in that, significantly less actually, right? So as the S&P made new highs, the number of stocks advancing actually, was declining. And what did that kind of forecast there is that, hey, yeah, the market may be going up, but it's not all that healthy of an uptrend. And obviously that was the prelude of, the financial crisis. Similar situation here in 2015, leading up to kind of a multiple double-digit drawdown here is about 12 and 14% or so. S&P making new highs here. Number of issues actually participating in that trend dropping significantly, showing like, yeah, the market's going up, but it's not really all that healthy. Not enough issues are really participating in that. And we're fine here. You can see a huge spike here. This hasn't really kept pace with that. I think until this starts to roll over a bit, there's probably nothing to be too concerned with. The issue comes from when we look at what's going on in the NASDAQ, which is this one. Top chart here is the NASDAQ. The bottom chart is the NASDAQ advanced decline line, right? And so again, here, NASDAQ going higher, number of issues participating in it, downtrend. Obviously, look what happened here after a fact, right? And this is that 2015 and 16 area. And this is where we're at today. NASDAQ's, kind of flat over the past few months, slightly maybe down as of yesterday, but number of issues actually participating in that trend significantly down, right? So yeah, the NASDAQ might be going up or flat, but the number of stocks actually participating in that, definitely not matching the price level there. That's what you mean by breadth. You really, this line should be up here as well. And it's not. So, and I've been saying for the past, few months, I think it was from February or March, the webinar, and I was talking about how we really haven't had much tech exposure since I think it was like October of last year. I've said like, yeah, you just don't want to be in tech right now. Like that's just not the best place to be. There's better, from a risk reward aspect, I just think there's better places to be right now. And this stuff has all kind of confirmed that. So this is the semiconductor. So the top line here is the NASDAQ in green. The bottom is semiconductors, and semiconductors, can act as a leading indicator a little bit to what's going on in the overall technology space. And again, so you look at, hey, if the NASDAQ is making new highs, semiconductors are not participating in that. That might be, signs of caution from a short-term aspect, not necessarily meaning again that it's a major issue, but something to pay attention to. And again, you can see it here. NASDAQ making new highs, semiconductors couldn't really keep pace with that. NASDAQ had a pretty big drawdown there. And this is where we're at here. I think, we've seen semiconductors kind of roll over. And so the NASDAQ has kind of been a more flat as semiconductors have rolled over. So the thing to watch is, will semiconductors continue to roll over? And if so, if semiconductors are leading as, kind of a leading indicator of what's going on, or what will happen within the NASDAQ overall, and will the NASDAQ kind of lead the other indices, lead the S&P 500, then, looking at that plus, looking at some of the other things that we're talking about, like the sectors that are showing positive momentum, does show, yeah, maybe the next few months might be a little more challenging in the market, something to pay attention to. So this is kind of where I'm going with that. This is utilities, right? So the top line, XLU is a utilities ETF. This is just going back to like 2019 here. But really what I want to show is like what's going on recently here. This is the percent of utility stocks making 13-week highs, 13 weeks and a quarter. So, and this is the percentage making 13-week highs. Obviously, nice uptrend there overall for utility stocks. Well, what are utility stocks? Typically defensive in nature, right? So you're seeing defensive, one of the defensive sectors, having an uptrend with the percentage of stocks making 13-week highs. Now, it's not necessarily a bad thing. If every sector in the market has, increasing a percentage of stocks within that sector are increasingly making new highs. That's great. The problem is when you see it mostly coming from defensive sectors and the offensive sectors are not participating in that as much. That's kind of when it's like, okay, well, maybe there's some issues under the hood. And that's kind of what I think is going on right now. So you've got utilities, nice uptrend here. Again, though, defensive sector in nature. XLP, consumer staples, right? Again, more of a defensive sector in nature. Good uptrend for consumer staples. So both of those are good, other than when you're starting to look and it's like, hey, technology, and I already went over this, not participating as much, right? I mean, they not as many stocks making, 13-week highs here for technology. So technology has really kind of taken a step back recently, and kind of consolidated. Not as many stocks participating in the uptrend there, and then you kind of see consumer discretionary kind of been flat. Like again, so you see the defensive sectors, more stocks making new highs. The offensive sectors, the sectors that you would want to see doing really well if you were expecting the market to, have a major growth spurt, not participating as much. So again, nothing to, as of right now, to totally freak out about, and maybe not anything to freak out about. But I think, again, just more challenging environment, more things to kind of raise an eyebrow to and say, okay, well, probably not a ton that would have to happen to freak out the market a little bit and to see maybe a 10% correction. Two other things I want to kind of go over briefly. Treasuries have not been a good place to be. This has been a really difficult year for the bond market overall. I mean, the bond market's down about 3 to 3.5% as of yesterday, year to date. Treasuries have just gotten absolutely crushed this year, especially from an aspect that treasuries are typically, safer money. And you've seen treasuries, just get absolutely crushed. And obviously that's not a good thing for the bond market. And obviously that has to do with inflation expectations, interest rates. Because of that, interest rates spiked up a little bit. But you're seeing, though, have treasuries found a bottom? And again, treasuries, are they more offensive or defensive in nature from an investment aspect? Well, they're more defensive in nature, right? And did they find a bottom here, right? And if so, you see treasuries found. So you go through all the data, right? You got treasuries may have found a bottom here. Utilities defensive in nature, looking okay. Consumer staples defensive in nature, looking okay. Technology offensive in nature, not looking as good. Consumer discretionary, not looking great. So you put all that in there and it's like, okay, well, maybe there's some things to pay attention to. So, treasuries, have they found a bottom? And if so, if you see treasuries spike up here, that's probably not a great thing for the equity markets, again, heading into year 2 of the recovery, heading into the summer months, things of that nature. And then you've got gold on the next page, right? Similar situation. Gold has not been a great place to be for the past, past 5 months or so, 6 months. I think it was August where they topped out. But again, same thing here. They kind of caught a bid here. Have they bottomed? Have they gotten a short-term bottom? I'm not suggesting that's it's a long-term bottom of, 2-year run or anything like that. But, if you see gold and treasuries all turning at the same time, and that's when, utilities and consumer staples start, outperforming the other offensive sectors, it's like, everything's kind of pointing in the same direction. Now, I think one thing to take into consideration is markets can kind of correct through price or time. And what I mean by that is the market could trade sideways for 3 months, right? I mean, it could basically be flat for 3 months. And that would be more of a, consolidation through time. It could be flat for 6 months, who knows? Or it could correct by 15%, get it over with and, get right back on track. So just because you're seeing things, kind of rotating defensively doesn't necessarily mean that the market has to have this major pullback. It just means that it might be time for things to kind of take a little bit of a breather. I mentioned earlier, maybe the easy trades are done. Maybe the easy money is done for now. I think June, July, and August are going to be really interesting. I think we'll probably, again, I think this is one of those time periods that seasonality will matter. I don't think it always does. So I think it is prudent to start to pay attention a little bit more to what's going on under the hood. And then just a really quick recap. Capital gain taxes again haven't historically caused a market shock. I know, and that's the thing. I think we'll see, some more volatility here in the next few months, and I'm sure that when that happens, you're going to see all the news stations talking about it's because of capital gain taxes. I don't think it'll be because of capital gain taxes. I'm not a fan of raising taxes across the board on everything, but I don't think any sort of market shock would be because of that. I just think the market needs a breather. Momentum across the board, still moving, towards more defensive sectors. So I think that's something that certainly keeping our eye on. Market breadth has begun deteriorating a bit, not too crazy, but it has been slowing. And I've been talking about that now for a couple of months. Year two in recoveries, it's been choppy in the past. You go back again after the .com bubble, after the financial crisis, that first 12 months after, off of those bottoms. It was gangbusters. It was great. Really easy money to be made during those time periods. Year two, a little bit more difficult. Some things get so overvalued, so much money pours in and things get, shoot up in price so fast that things get overvalued. And it makes people take a step back and say, wait a minute, some of these prices don't make sense. Defensive sectors making more new highs than offensive sectors for the time being. Treasuries and gold, have they found a bottom? And if so, couple that with the whole defensive sectors making new highs, probably again, a little bit more of a challenging environment here moving forward. So personally, I would expect a little bit of a choppy, summer. Time will tell. We're gonna follow the data. That's what we do. It's worked really, really well for us. We have a system that we built, and we completely removed emotion from it. So if the data starts getting more offensive, then hey, we'll get more offensive. If the data goes more defensive, hey, that's fine. We'll get more defensive. So we're gonna just follow our process. So appreciate everyone's time, and let me know your thoughts. If you guys have any suggestions, would like to see anything on these webinars, feel free to shoot me a message on it, and I'll try to include it. Thank you.